Hey everyone, it's Daniel here from InfoVest. Hope you're all doing well. Let's talk about the FOMC. So we had the FOMC meeting yesterday at 2 p.m. The statement came out, and then we had the press conference. So let's talk about how the markets reacted and what Jerome Powell discussed and what he talked about during that meeting. But let's first start with the statement. So the statement came out, and the statement took out some couple key words that were really, really important. The first thing that came out was that the statement took out ongoing rate hikes. So that ongoing rate hikes basically gave fuel to the equity markets in the beginning, because that suggests that, hey, we're probably not going to see as aggressive rate hikes as they were just projecting 2, 3, 4 weeks back before the whole banking crisis. And also, along with the statement, you had the projections that the federal funds rate was basically unchanged, left at 5.1%. However, they did not revise it down, so which means that they left the door open for another 25 basis point rate hike. So although they did raise rates yesterday by 25 basis points, so now the rates are in between the range of 4.75 to 5%. There's a 50-50 chance that the Fed could raise rates again in the next meeting in May and do another 25 basis point rate hike. Now, the market is 50-50 because the Fed basically gave an expected, okay? To me, this was an expected dovish rate hike. So it was expected that he was going to come out and do a 25 basis point, right? And it was expected that he was not going to be overly hawkish. And there would be some expectation that he would talk about the banking sector. Now, in the statement, he did say that the banks are resilient and totally fine. He did say that we'll continue with the QT. We will continue with did say some rate hikes may be needed, but we still don't know. So change from ongoing rate hikes to some may be needed. And that the job market is still very strong, robust, and still we need to bring inflation down. So that was all in the statement. Now, the press conference at 2:30 basically reiterating the same things and basically saying that, hey, we're not sure. Depends on what unfolds. We'll have to be attentive with the banking sector. He basically did say that nothing's going to go wrong, right? We don't expect that any more issues are going to be, shown up later in the future, which obviously he can be very much wrong. But he says we're going to be attentive, watch how the banking sector plays out, watch if there's any more implosions, and basically assess the data and see what happens. Which basically means the following. Which means that, hey, we're probably, maybe by May, still going to raise rates, especially if inflation's still high up, right? We saw UK's inflation numbers spiked up. So if the US's numbers spike up again, so it may present a case that we will go and hike rates again another 25 basis point. And we will continue to do so if the job market is still strong and the banking sector is still resilient and strong. So if all of April and beginning of May is still fine, then they could go ahead with another 25 basis point rate hike and continue to watch and see what happens there. Now, the Fed did mention that we are still in a disinflationary process, right? And that the issues that you're seeing in the banking sector does kind of equate to a rate hike and does bring in this deflationary environment. So, and he said that through saying that credit is more likely to be very tight in many of these institutions and borrowers and whatnot going forward, which is expected to bring down demand and hopefully bring down the inflation level as well. So he was very careful in the way he spoke and the words that came out. And And the markets, the stock market was basically all choppy all over the place. The bond market, on the other hand, was basically rallying, pricing in that, hey, we're probably going to see a pause, and after that pause we're going to probably see rate cuts very soon, and the markets are pricing in that we're going to get rate cuts, at least by the end of this year, and it might be a couple of them, or maybe in the summer, and so on. So that expectation of rate cuts by the end of the year, or maybe the start of next year, is a telling sign that tells you that if we're going to get rate cuts, something is eventually going to break. And from what I got from, to me, right? The key word is to me. What I got from that press conference is that we saw the Federal Reserve basically say that if the economy is still doing well, we're going to attack it because we've got an inflation target that we need to go after, unless something gets worse and unless something breaks even further, then we will pause and halt, and then probably even cut rates. And it is the breaking of something that brings the disinflationary process. And I'm pretty sure he understands that this breaking of something, right, that happened in the banking sector is the beginning of the disinflationary process. Because when you break something, when demand completely crushes, when you basically crush demand, you're bringing inflation lower, right? So you're bringing inflation lower, and that's how you've seen inflation in the past when you had hard landings in a big recession. So to me, it's very clear that, and I've been saying this for a very long time on this channel, either they will hike rates and continue to hike rates, and they'll continue to tighten, which they said in their statement. They didn't say we're going to stop QT, we're going to do QE all of a sudden, we're going to start easing. No. They're going to continue with QT. They're going to continue to keep the markets and credit tight, like he said, until something breaks. And when something breaks, then they have the tools to go in and step in and do something about it. So this is very telling, because we have seen similar signs like in 2008, like in 2000 as well. But let's pick 2008, for example, where we had Bear Stearns basically implode, and you had JP Morgan come in and buy up Bear Stearns, and then you had this quietness period, right? And then in 2008, so the markets kind of rallied and said, oh, okay, everything's fine, and we're going to see, this is the end of the banking crisis. But lo and behold, after a couple months later, in September, that's when everything started to break and fall. And they were cutting rates during that time, yet the stock market was plunging and plunging and plunging, right? And what was also interesting during that time was Yellen was also speaking during that time. And she mentioned that the government, in terms of saving the depositors for other banks, there may not be enough insurance to safeguard the other banks like SIVB, which caused basically, boom, a big panic sell close to the end of the day in the stock market. And bonds all day continued to rally, as fear is good for bonds, recession is good for bonds, cutting rates is good for bonds, and the stock market was just choppy all day and then finally sold off. So can we see just like similar signs like 2008 in this year, where the Fed, pauses, maybe they hike one more time in May, and then start to pause, and then after maybe by June, July, or at least maybe September, we start to see things break and get worse off. More unemployment rate skyrockets, and then the inflation to come down. I think that's the likely scenario. And I think the Fed knows it, but they're just obviously not explicitly coming and telling you that, right? Just like you saw in yesterday's meeting, the Fed came out and says all the depositors are safe. Don't worry about your deposits in any bank, and we will do everything we can to save you. Yet the head of the U.S. Treasury, Yellen, said the complete opposite. So completely two different views. And Yellen was a federal chair back in the day, back when before Powell became chair, and so she understands also what the job is of the Federal Reserve, what the job is when it comes to monetary policy, and it's very interesting to see that even though they have two similar experiences and kind of similar mindsets, that the comments on the deposits were completely different. Which means what? Which means that if they're not going to backstop and save everybody on this crash or crisis, then definitely that can cause more panic and that rude awakening, like I was saying, in the equity markets. So the equity markets can be in la la land for all they like. They can rally, they can go up, they can be choppy. I think it's going to be very confusing. I think these next coming months, it's going to be really confusing until something truly breaks and then the panic kicks in. We haven't seen true panic. This is just the beginning. Like I said in the BlackRock and Blackstone video, this is just the beginning. These are just the cracks. You're just seeing the cracks, and guess what? The cracks are eventually going to get bigger and bigger, and you're going to see, you see how this all pans out later this year. So let me know what you think. Leave a comment below, subscribe, hit the like button, the bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye.